Before we get started, I want to remind everyone that the information in this presentation is not to be or construed as investment advice. The information presented are subject to change without notice, and while we have made every reasonable effort to ensure that the content is reliable and accurate, we have not independently verified the content and are not responsible for errors therein. Please consult a professional advisor before putting a loonie in any of these financial markets. Hi everyone, my name is Richard Diaz and welcome back to the IceCap Canadian Market Wrap. In this week's episode, we're going to talk about Canadian manufacture, or rather the lack thereof, and why tariffs are hurting that industry more than expected. For this, we're going to rely on some of the charts and analysis of one of Canada's best economists and macro strategists, and someone who I admire and respect, Stéfane Marion of the National Bank. As you know, most of the charts I share with you every week are done by yours truly. I've always been of the view that you can't really understand what's going on in an economy without getting stuck into the data yourself. That is not always feasible, of course, and sometimes there are just resources and people out there that are simply better. And so, before I go on, I want to give credit where it's due and share with you one of my favorite resources, the National Bank's repository of charts and reports that are freely available to everyone. I look at this website every month and continue to be impressed by all the great work Mr. Marion and his team do. If you're interested in the Canadian economy or want to double check my work, I cannot recommend this site enough. I'll put a link in the description below. One of the things I've gotten wrong this year is that President Trump would insist on keeping tariffs on Canadian products. I still think there is a deal to be made with our recalcitrant neighbors and that our government has handled this negotiation horribly. Trudeau alienating a notoriously thin-skinned Trump and Carney going to Europe on day one of his administration is not the way I would have handled it. But in any event, the tariffs remain. What's important to note, however, is how small they are relative to the rest of the world. This is because of the USMCA, the rebooted NAFTA agreement, our free trade agreement with Mexico and the US. Most products, by design, are exempt from tariff. Nevertheless, the tariffs have hurt. We saw this a couple of weeks ago when GDP contracted under the weight of exports and investment. And although exports to the United States have rebounded in July, the jury is still out on the long-term impacts of this U.S. protectionism. Uncertainty is also a huge problem because even punitive economic policy can be navigated through or worked around when it is clear and predictable and businesses know what to expect. The following chart shows an index of economic policy uncertainty at the top and machinery and equipment CAPEX growth at the bottom. And it makes the point, in a very real sense, that a bad deal is better than no deal at all. But stepping back, the real reason Canada has been hurt so badly by relatively small tariffs is because of a lack of competitiveness. Canada is now at the bottom of the table when compared to its rich country peers in terms of competitiveness. This is, of course, related to a subject you have heard me talk a lot about on this channel and on the Loonie Hour, and that is one of productivity growth. Competitiveness refers to a firm or sector or a country's ability to succeed in markets, while productivity measures the efficiency of resources to produce that output. They are clearly linked. What is important to note is that this was not always true. Canada's industrial competitiveness used to be highly ranked and has fallen over the last 20 years. Admittedly, one needs to be careful when using these rankings as they can sometimes be subjective. Objectively, Canada's productivity growth has been horrible. The 10-year compound annual growth rate of Canada's productivity is basically zero at 0.1%. This is a disaster. Or as the Bank of Canada put it, an emergency. As we have discussed before, Canada's recent GDP growth was entirely driven by importing warm bodies and not improving our labor force productivity. This is not only stupid and reckless, it is unsustainable and has left Canada vulnerable to outside shocks. Another reason Canada's manufacturing sector is so vulnerable is because of its size. Successive governments and economic policy grandees have eschewed the merits of manufacturing in favor of services. This was a mistake. Canada's industrial base has become far too small, leaving us at the mercy of the whims of outsiders, good and bad, And you will note that China and the US are desperate to protect their industrial base, and we should take a page out of their book. Another reason that Canada's manufacturing sector has shrunk so much is because of overregulation. There's been a lot made of the legislation to neuter Canada's natural resource sector. Less has been said about manufacturing, but the data is very clear. And without a change in philosophy about the role of government, Canada's manufacturing sector will continue to be under pressure. It won't grow, and it won't help our productivity. Canada needs a much stronger manufacturing base to become more independent and resilient to shocks. And it starts at the top with incentivizing private capital rather than crowding it out. This is because of the simple reality that most of Canada's CAPEX, in fact, most CAPEX full stop, is sourced from the private sector. And without capital investment in the manufacturing or any other sector, for example, oil, Canada will continue to have productivity problems and the litany of troubles that brings. All right, that's a wrap on this week's episode. Thanks again for watching. Please like, subscribe, and follow for more. And as always, we manage money for families all across Canada and the world, so please feel free to get in touch.